Hey everybody, I hope everyone is doing well and had a good day. In this video, we're going to review the E-mini 5-minute chart for Monday, March 23rd, 2026. Here's the daily chart. Tight bear channel breaking below this upper trading range. This might be support. The bottom of the trading range back here, this was November the 21st, 2025. Market broke far below this price, and then going into the day, we had a gap up. Bear trend bar Friday, it's a bad buy signal, so probably traders selling above this bar. It's a bad stop order signal bar. The channel down is tight enough that it's probably going to get some sort of second leg down. 4-bar micro channel into Friday. And then the 5-minute today, big gap up going into the day, which increases the probability that there will be some sort of second leg within the first hour. And that's because you can think about a breakout as, you can think about a gap as a breakout. A gap is simply a space between two prices, the close of Friday and the open of the day today. There's a big space between these two prices. It's really no different than if there was one 5-minute candle opening here and closing here, a big bull breakout. The expectation is that, well, first of all, traders get trapped by that breakout, or in this case, by the gap. And the expectation is that there is support below. The pullback will probably be shallow, and there will probably be a second leg to the upside. So gap up above Friday's high. I said there's probably sellers above yesterday's high, but the gap up going into the day, like I said, increases the probability that there are buyers below bar 1 and increases the probability of a second leg up. Bar 1, after the big gap up, it's a bear trend bar closing on its low. It's good for the bears. It's far above the moving average. The bar itself is fairly strong. You might have stop order bears selling below bar 1. The only concern would be, like I said, the gap up, likely to get a second leg. So we find buyers below bar 1. Bar 2, it's a strong bull reversal bar closing on its high. The traders who sold below bar 1 are trapped on bar 2. If you imagine you take the stop order sell below bar 1, you're expecting lower prices, and bar 2 is your entry bar. You're disappointed. You sold here. Now you're holding a losing position, and you're hoping there's any sort of small second leg sideways to down after bar 1 that would allow you to avoid a loss. So maybe you sell below 1, scale in, sell in the sell zone of bar 1, hoping just to maybe break even on the entire trade. And bar 3 would allow you to do that, assuming you had a wide enough stop, because if you sold below bar 1, sold more higher, average price is somewhere in here between the two prices, and bar 3, of course, gets there. So bar 2 and the gap up, likely to get a second leg. What about selling bar 3, second reversal, 1, and then 3? Bar 3, it's a big bar and it's a trading range bar, which means it's a bad stop order signal bar in either direction. There's probably buyers below bar 3 and also probably sellers above bar 3. Inside bar 4, nothing to sell, probably going at least a little bit higher, but still probably sellers above bar 3, trading range bar. And we're getting overlap on the bars, the first 4 bars of the day. Market's channeling up. So breaking out to a new high, bar 5, but still nothing to sell. 4-bar micro channel, 1 through 5, probably buyers below 5. And then 6, continuing higher. The micro channel continuing, bull bar closing on its high. There might be some sort of pullback here. The market rallied, paused, rallied, implied pullback, rallied a third time. Maybe you get a minor reversal, but the buying is strong enough and the selling is so weak The selling pressure through here is so weak that any reversal will probably only be minor. Probably buyers below 6 and in the buy zone of 6. 7, it's a good bear reversal bar closing on its low, but the context not very good because the buying is fairly strong. The first sell signal here will probably be minor. If you sell below 7, you're taking a low probability trade. The gap up and the rally 2 through 6 trapped traders below. That creates support, which means the downside is limited and a second leg up is likely. So bar 7, probably more buyers below 7, maybe not directly below 7. Maybe they come in below 6, but I think the downside here is limited. And bar 8, finding buyers below support, bars 5 and 6 lows. 7 was a strong enough bar. Maybe it gets a small second leg sideways to down, but if you're selling, you have to exit above bar 8. Market's channeling at this point, technically channeling, because we had the gap up, considered a breakout, a pullback below bar 1 on bar 2, but then another micro channel here, and then a pullback. So this may have reset the leg count to some degree. Leg 1 for the bulls, pullback below 7. Now the market's in the channel phase, so probably sellers above bar 7. But high 1 buy and a tight bull channel, it's a reasonable stop order buy, which is why if you sold, you can exit above bar 8. 9, it's a bad stop order sell, probably buyers below, and again, probably testing the high of 7 at a minimum. So it's probably a buy the close bar because we're probably going at least a little bit higher. And then 10 breaking out to a new high, but in the channel phase, you expect sellers at the new high. So traders are buying pullbacks and then probably selling when the market breaks out to a new high. Maybe it's leg 3, gap up, pullback, leg 2, pullback, leg 3. You can count 3 pushes through here, 1, 2, 3. And then bar 10, one of the strongest bars in the rally, occurring in a possible late leg, very far above the moving average. And then again, the structure, it's a bull channel. So your expectation should be that there's probably sellers at the new high. The breakout of the channel line will probably fail. The market will probably correct for a couple of legs. The channel is likely to evolve into a trading range, which means buying here is not ideal. This might be a profit-taking bar. Bulls get another bar, but trading range, bar, big tails. Body maybe about half the size of the bar, not ideal for buying. 12, bear, breakout bar. Strong enough bar, it'll probably get a small second leg. I think it's reasonable to exit longs below bar 12, but I think 8 through 11 is a strong enough rally for a second leg. The problem with leg count, counting 3 legs up here, is that the channel up is tight and the selling pressure has not been all that strong. So any reversal is likely to be minor, and then we'll probably test the highs again. I meant to add this resistance as well. This was from last Thursday. And the reason, I believe that's Thursday's high, the reason I'm not putting the high of the day is for 2 reasons. And the first is that I think the best fit line is probably the close of bar 69 because price tested this line 4 times. It tested it on 68, 69, 70, and 71. So I think that's the best fit line of resistance. But also, I prefer overshoots to undershoots. So you'll see when I draw channel lines or any kind of support and resistance, I do the more conservative one because I prefer overshoots, which we're going to see later in this review based on this line of resistance. So I meant to have that drawn so you can see the reaction to it on 7. Market's breaking above it here. I said 12 likely to get a small second leg. 13 may have been that second leg. Not a great follow-through bar for the bears. I still think the micro channel here is probably going to get a second leg test of the highs. Bears 12, bear breakout, pause 13, second leg 14. Now it's 2 legs sideways to down. Probably the downside here is probably limited. 15, another pause bar. Not a great stop order buy, but also not great for selling because now you have a bear breakout, a pause, technically a pullback, and then a second leg against the tight channel. So really not ideal for selling. This looks like a minor reversal. It looks like a leg in a trading range. If it's going to be a major reversal, you prefer to see big consecutive bear trend bars breaking the bull trend line, but we don't have that here. 16 outside up, probably on its way to test the highs. The question is, how disappointed are the traders who bought the close 11 with 12 through 15? If they're disappointed, the traders who bought here, they may look to sell here. Either way, we're channeling up. So even if they don't come in and sell here, they'll probably sell at a new high. 16 is a breakout bar, trapping traders down here. So 17 is testing support. It's probably going to get a second leg up. So buying here makes sense in the buy zone of 16. And as far as selling, it's a tight trading range after a tight bull channel. I can see the argument as we start to go sideways. We're far above the moving average. And if we go sideways enough, for long enough, the bulls will become disappointed because they're trading. The bulls who are buying based on momentum. They're paying above average price. And if they start to lose momentum, they will stop buying and they'll look to buy a pullback instead. Bulls get a second leg to the new high, big bull bar 19. How much of the bar is actually breaking out above bar 11? Maybe 10-15% of the bar. So the majority of the bar is within this range, and now it's a more clear 3 legs up with maybe 6 or 7 bars going sideways through here. Expectation in a channel is traders are selling here, bears are selling to initiate short positions, and the traders, the bulls who are buying pullbacks, are taking profits. So probably sellers in this area. As strong a bar 19 looks, it's really not ideal. Bad follow through bar, especially once you're 20 or 30 bars into a bull trend. It's really not ideal to buy a big bull trend bar, especially at the new high when the market's in the channel phase. 21, reasonable to exit longs below 21. There's a possibility that this channel begins to evolve into a trading range because that's what markets tend to do. If you study the market cycle, you'll see that usually after a breakout and a pullback, the market begins to channel, and the channel evolves into a trading range most of the time, which is to say, most of the time it does not break out in the direction of the channel. In this case, does not break out above the bull channel line into an even stronger bull trend, but instead the market reverses in the opposite direction, in this case down, and the channel evolves into a trading range. And because we had the gap up and a pullback below bar 1, the bottom of the trading range could be all the way down here. Bear bar closing on its low 22. It's probably a sell to close bar based on the structure. It's far above the moving average. It's 3 legs up. We've gone sideways enough through here. This may have been a final flag for the bulls. And now you're getting a bear bar, another bear bar, another bear bar. The traders who are buying 19 are disappointed with the follow through, and they may be giving up here on bar 22. Reasonable stop order sell 22. 23, it's a high one, but a late leg at resistance. Probably more sellers above 23, even though it's a good looking bull bar. And then the market was unable to get above 23. 24, bear bar closing on its low, probably going at least a little bit lower. It's a micro channel since 21, so a reasonable bar to sell. If you're long, you can get out below 24. Again, the correction, or as this channel evolves into a trading range, probably the first target is here, 16 low, which is also around the moving average, but then there's the bar 8 low, and all the way down at the bar 2 low. So the downside, there's room to the downside for the bears. And then where's the stop order buy for the bulls? It just does not exist. Here's a give up bar, 26, possible measuring gap, nothing to buy. It's always in short. Pause bar, sellers above, sell to close. 28, bad stop order buy, sellers above, sell to close. Another big bear trend bar, 29, probably sell to close, probably going to at least the bar 2 low. And then we'll see what happens there. Will we find support, or is this strong enough to create a bear trend? In general, I think the probability that today is a strong bear trend day, or in this case, reversal day, rally on the open into a strong bear trend day, is unlikely because of the rally, the big gap up, and the follow-through buying. It's probably going to be some sort of trading range day. But strong enough selling through here, it's unlikely that this is the bottom, or that bar 2 is the low of the day. We're probably going at least a little bit lower. I said it's sell to close. It's always in short. This bear breakout is strong, and it's probably going to get a second leg down. 30, a follow-through bar, still sell to close. Sell for any reason, probably going lower. Minor reversal, 31 through 33. It's a wedge bear flag on a lower time frame. You can count 3 legs. 1, 2, 3. 33 is probably a sell to close bar. Sellers above likely. Bears get trend resumption. Another trend bar, 36. Strong enough bar, probably going to get a second leg down. And the sell-off, this big bear breakout, 24 through 30, is likely to get a second leg. 37 is a strong bull bar, and that's a problem for the bears because the bears who sold 36 are disappointed with bar 37. 37 is a bar that you have to respect as an always-in flipping bar, which means if you're short for any reason, anywhere, it's reasonable to exit shorts above 37. That's a strong bull bar, and even if we don't reverse here, and maybe this is not the low of the day, the odds are we'll find buyers below 36 and 37. Bad entry bar, 37 is probably more caused by bears taking profits than aggressive or bulls buying aggressively. But it's still a strong enough bar to disappoint the traders who sold down here, testing the breakout point. So sellers here make sense. Test of the lows makes sense. But I think the downside below 37 is probably limited. Bulls get there's a reversal, pause, small second leg, testing resistance. Probably sellers in this area. Remember the bar 33 low is a breakout point created by bar 34. The traders who bought below 33, trading range bar, betting on a weak low 1, they got trapped. And when the market tests this area again, there's probably going to be sellers here. And then I said this sell-off, the sell-off down to 36 is strong enough for a second leg. Now the reversal disappoints the traders who sold down here, and that may limit the downside. But it's similar to what I said on bar 1. If you sell below bar 1 and then sell in the sell zone of 1, maybe sell at the high of bar 1, you're probably going to be able to avoid a loss at a minimum, and that's probably true for this here as well. If you sell 36, sell more at a reasonable place in the sell zone of the micro channel, the breakout point, or even below a bear bar like 41, you'll probably be able to avoid a loss, and you can see what happened. You sell to close 36, sell more below the stop order, signal bar 41, market tests the break-even price. Now the trend resumption here by the bears is weak. The bulls are hoping this is a higher low major trend reversal, and the pattern really doesn't look great, but the bulls have done the minimum. They broke the trend line there. They broke this bear trend line, so there's a trend line break by the bulls, and then the trend resumption is a two-legged move, and it's a fractal. You can count 3 pushes down here, 1, 2, 3, correction, minor reversal, but tight bear channel, pullback, second leg, and then the second leg is a spike in channel 1, 2, 3 pushes down. Testing support, we talked about that. If you sell here, sell more higher. Market tests the average entry price, and the traders who sold 36 are probably disappointed by the rally, and they're using these bars as an opportunity to scale in and avoid a loss. So there's a stop order buy above 48, although it's low probability at this time. But I did say that it's probably some sort of trading range day, not a bear trend day. And if it's not a bear trend day, we may have a low of the day at this point. And then 49, strong bull breakout bar, increases the probability that the low of the day is in. It's a strong enough breakout bar. It's probably going to get a second leg. It's a reasonable buy and scale in. Minor reversal to the breakout point, the moving average, and these bars, the highs of these bars to the left. Breakout, follow through, pullback, bulls likely to get a second leg. And now we're back into the channel phase problem. Bull breakout, pullback. Now we're in the channel phase, which means sellers at the new high. So traders sell at the high, they buy the pullback, probably going to test the highs again. Not a very good stop order sell signal through here. Still always in long, still probably going at least a little bit higher. Tight trading range, breaks out to the upside. Now you can count 3 legs up, not an ideal buy on bar 61, but it's a breakout bar, and breakouts usually get second legs. And the traders who were selling anywhere through here get trapped on bar 61. So probably buyers below, and at least a small second leg up, likely. Follow through bar, bad stop order sell signal bar, probably buyers below. Tight trading range in a late leg in a trading range day. Looks like we're around the middle of the day's range as well. It's really not ideal for trading. You know, in a trading range, you want to buy low and sell high. And here the market's near the midpoint of the day. Also on a trading range day, the open of the day can act like a magnet. So put that in. Tight trading range, not good for stop order trading. Second leg up for the bulls, still likely. The problem I have with buying here is you can count 3 legs up to resistance. What's the resistance? This was a strong bear breakout, and I'm not sure that it's had its second leg yet. It got a small second leg, 33 through 36, but this entire tight bear channel from 21 to 36 is a bear breakout on a higher time frame. And then this bull channel from the low of the day is a bear flag. Bull channel, bear flag, they operate the same way. They're indistinguishable. So bear breakout, bear flag, bears still may get a second leg. And then what's the resistance? There's the breakout point here. And every bar, really, the pause bar 27, all these bars to the left act as support and resistance. And when you combine the fact that it's 3 or 4 legs up, and then you start getting a tight trading range, it's really not ideal for buying. Breakout follow through 69.70 after 3 legs up. Bull channel likely to evolve into a trading range. First target's down here. Nothing to buy. No stop order buy signal. It's probably sell to close, always in short. But late in the day, really not ideal for trading. Nothing to buy, which means stop order buys are good. Limit order sells. There's probably traders selling above these bars. The first pullback is likely to be minor and then lead to a second leg down. So 74. On a smaller time frame, you can probably count 2 legs sideways to up, but testing resistance, the moving average after a bear breakout. So likely a minor reversal, test of the lows likely, and then with the market cycle, spike in channel evolving into a trading range, bar 52 low, support, the start of the channel, or the lowest point of the start of the channel is a magnet that the market may want to test with a second leg down. 75 testing that resistance, the moving average up here, bar 69 low, breakout point. the open of the day. Breakout mode 76. Bears get their second leg. 1, pullback 2. Strong enough bar 77. Probably will get a second leg down. I think we're going at least a little bit lower, but there might be buyers below 52. And then instead the market broke out strongly 78. Breakout point 48 high. And that may act as support because of the bar 49 breakout. The traders who sold down here disappointed by the rally, the spike in channel, and that may create support in this area. And the bears got more follow through 79, trapping the traders buying here. 3 bar bear spike, strong enough for a second leg down. One of the problems with it is it's a big second leg, 1, pullback 2. It's testing support low in a trading range day. Of course, it's also late in the day, but if we put that aside for now, the problem is that it's a nested 2 legs down to support in a trading range. 1, pullback 2, 1, pullback 2, and just late in the day. So we may have found support and we may start to go more sideways through here because the market knows the traders who were buying or the traders who were selling over here. And I say over here, this general area, even if you put a horizontal line down here, the spike in channel, the bulls controlled the price for enough distance and enough time that the traders who sold down here are disappointed. So when the market comes back to this area, those traders who sold are now looking to buy back shorts. If they sold, scaled in, this becomes support. All right, that's going to be it for today's end of day review. Thanks everybody for watching, and I hope everybody has a good night.